Joining me now to kick off the week is Ron Insana, CEO of Insana Information Partners. Ron, great to have you back at the desk.
Thanks for having me back. Good to see you again.
So I want to get a check-in on your market sentiment because you were last on in December and you were a bear then, and that was before we were in a war with Iran, before oil hit $100 a barrel or more, and before some of this pressure that we've seen on tech. How are you feeling about the market now?
About as bad as I did then. I think there's a 50-50 chance that we go from correction to bear market over the course of the next couple of months, which, strictly defined would be a 20% downdraft for the major averages, maybe a little bit more, particularly if the war is not settled in relatively short order. I think if you start to see crude oil, jump to 110, 120 here in the States or 130, 140 in London, there's also this lagged effect that the crude oil that we have that's been distributed around the world from several months ago is just reaching the shores of these destination countries, whether it's in Asia or in Europe. So this disruption that's taking place in the Gulf now won't really hit other countries for several weeks to come. So we may see supply shortages of fertilizer, of energy products, of agricultural products around the world that could create a weaker global economy and by extension hurt the United States and keep inflation above target for some time to come.
Okay, so we have seen stocks rallying a bit this morning on hopes that the war could be over soon. We have seen the NASDAQ dip into negative territory
We also
already.
hear that every Monday morning.
If the war ends tomorrow, where does the market go?
Well, you'd have to expect it to be a rocket shot straight higher just on a relief rally. Whether or not it eliminates all the problems that we have as a consequence of not just the war, but the lingering effects of tariffs. As you said earlier, the gutting of some of the technology stocks that are down. And then all the alternative asset managers are down 20, 30, 40% as well. And so there are still these lingering concerns about credit quality in the private credit space. So I don't think we have resolved all the issues that this market faces. The war would be one, the biggest one, but not all of them.
So your 50-50 correction to bear market, what does that change to if the war does end quickly?
Well, I think you get a big relief rally, and then you go back and contend with a couple of other issues. Can the Federal Reserve cut interest rates even if the war comes to a swift conclusion? Will tech rebound? And will alternative asset managers who have been, preventing investors from withdrawing their funds from certain private credit vehicles, is that a canary in the coal mine that there's problems in the credit markets that haven't yet made themselves fully known in the financial system?
And we actually saw the market starting to price in the potential for a rate hike later this year versus another cut because of inflationary pressures. How damaging would that be for stocks?
A rate hike would be, all bear markets start with a rate hike, right? So we've had just a garden variety correction, despite how big the headlines have been. The S&P before this morning's rally was down 9.7% from its high. The Dow, the NASDAQ, and the Russell were all down more than 10%. We're negative for the year. And that's without the Federal Reserve getting less friendly. So my late friend Marty Zweig, very famous investor, said, don't fight the Fed, don't fight the tape. Tape doesn't look that great. The Fed's being called into question. If you were to get those two things combined where the tape gets weaker and the Fed's leaning towards tighter policy, you could pretty much guarantee there'd be more downside in the stock market.
We're also hearing more about stagflation. That has entered the conversation. Is that base case now, or do you think that's still just a risk case?
No, that's been my base case since last year, since the end of last year. I don't know if we talked about it in December, but it's mini stagflation. I think Jay Powell was correct in his last public comments to suggest that anything like the 1970s and early 1980s is off the table. You would need a 15-year period to build that case where inflation's 13%, unemployment's 11%, and interest rates go to 20%. That's not where we are. But you could see the labor market stagnating or weakening. You could see GDP growth slowing, and you could see inflation holding above 3.5% for some period. And while it's not the worst of all worlds, 1980 was, as was the financial crisis in 2008, it's aggravating enough that consumers spend less, that policymakers are frozen because they don't know which item to focus on, a weaker economy or higher inflation. And it kind of just locks the economy into this, kind of no-go zone, if you will, or low hire, low fire, inflation that's uncomfortably high for most people, particularly middle and lower income individuals, and you get a stagnant economy.
You've also been cautious on the AI build out and the AI trade. Do you look at what's happening now, the gutting of tech, as you said, as just an overextended sector that's right sizing, or do you look at this as the beginning of a bubble unwinding?
Hard to tell. I mean, I think, we've had the SaaS apocalypse now, where software stocks, both in public and private markets, seem to be marked down rather substantially. I think what we don't know yet is whether or not any of these prominent AI companies can earn enough over time to fund the trillions of dollars they're spending on infrastructure. And if AI becomes a commodity and they don't have pricing power, and we can all buy, ChatGPT or Claude for $20 a month, is that market going to be big enough to finance what's expected to be at least a $3 trillion spend over a 5-year period? And I think that's where it gets a little sticky, and I think it's still too early to tell.
Is there anything in tech that you would look at as a safe bet right now, though?
Right now, I mean, certainly the valuations have come down a lot in the tech sector. In fact, the entire outperformance of the Mag 7 relative to the S&P is gone. And, we've seen Microsoft come down 26% from its highs. We've seen a lot of stocks really get taken out to the woodshed, including NVIDIA, which was the premier company in the space. We might be getting closer to a point where people can nibble safely. I wouldn't be throwing a ton of money yet at any area of the equity markets right now until we get some clarity around all the issues we've discussed so far.
So if you're someone sitting here right now with money in the market, what do you do? Do you hold? Do you trim?
We've always, it was editorial we've always suggested that, if you're overexposed to a specific area, you reduce it back to the weighting that it's supposed to be in your portfolio, and you take all those prudent portfolio management steps to make sure that you're not, too far out on a limb with respect to either individual stocks or specific sectors. So that kind of portfolio management is always wise. If you've got 10, 15, 20 years to retirement, you continue to dollar cost average, you put the money to work. My preference, like Warren Buffett's, is for just buying index funds and not getting too cute, unless you're really spending time studying individual stocks and you have a complete understanding of what their business model is. For most folks who don't have the time to pay attention that way, you can go with the S&P, the Qs, the Russell, or even the international index, and create a basket of those four and just keep putting the money away. Sock it away until you need it. If you need it in the short run, I'd be a little more careful and maybe buy some T-bills and hedge just a touch.
Last time you were on with us, you actually liked international over U.S. opportunities. Does everything happening in the world and also the recessionary risk that Europe, Asia is now facing change that view? A
little bit. I mean, I think the rest of the world is still modestly outperforming the U.S., but that differential is by how much they're down versus by how much they're up. So last year, we had European and Asian markets outperformed by leaps and bounds, 2 to 3x the United States. Now we have the U.S. down on the year, and Europe and Asia are, in some instances, still in positive territory, but only by a couple percentage points. So there's still a positive spread between the rest of the world and the United States. It's just not as pronounced as it was last year.
So as I think about your sentiment at the end of last year, which felt very bearish, to now 50% chance of a bear market, I mean, that's kind of a safe,
I could get more negative if you want me to.
I'm just curious, are you a little bit, do you think that what we've seen in terms of the sell-off, we're at valuations now that maybe are more justified and there's not necessarily reason to move lower?
Well, I mean, I think there's still the risk of moving lower, but the valuation question, I guess the PE on the S&P 500 is now down below 20, which is much, much closer to historic average. And so it's a safer environment relative to where we've been, but we have seen an uptick in interest rates as well, even without the Fed getting involved. So as rates go up, they're down a little bit this morning, but if they do continue higher, that changes, the relative value between bonds and stocks.
So what is it that you think investors might be underestimating right now?
Well, I think private credit risk, I still think is an issue. Whether it's systemic like 2008, I don't think it's that magnitude. To me, it still seems like it may create a shock that's more like the failure of long-term capital or the Asian currency crisis, where we get a big market disruption that shakes the tree, maybe prompts the Federal Reserve to cut interest rates, and then sets the stage for another rally down the road. I'm keeping as close an eye on that as possible. You know, it's impossible to escape the war right now as being the principal risk, both domestically and globally. I don't know if that bill means my time is up, but but I think that, you know, we're getting closer to where valuations are reasonable, but we still have these, you know, these major concerns, principally first around the war, then secondly, I think, around deterioration in private credit. That's very hard to assess because it's such an opaque market, and we don't know how these loans are being valued, and we can't see through those markets to get good information about where they stand.
We had Gareth Soloway on not too long ago. He's a trader. He looks at the charts, a technical analyst, if you will, and he has a 5,600 price target for the S&P 500 by year end.
Right, yeah.
Is that about right? Is that aggressive? Is it conservative?
I think it's right middle of the road. I think, you know, at this juncture, you know, if you're hovering around 6,000 and, you know, another 400 points to the downside wouldn't be shocking. That would again put us in bear market territory, you know, effectively. You know, we've broken, in technical terms, we've broken the 200-day moving average. There's some talk about a death cross in some of the major averages, which historically has led to further downside activity. It's not always a reliable indicator, but, you know, you've seen also what I would call a gutting of the market, right? You see the technology stocks get killed. You see in the Mag 7 have lost their outperformance. We've seen alternative asset managers and financial stocks also get hit. And usually when you see that type of internal deterioration, the averages are more likely to catch down to those sectors than the sectors are to catch up to the averages. So you've had big declines in a lot of different assets and a lot of different asset classes. Bitcoin is down. You know,
but is there any reason to be bullish right now? What would flip your outlook?
The war coming to a very swift conclusion, and oil flowing again, fertilizer flowing again, some measure of, I guess, stability in the Middle East that would not guarantee, because that's impossible, but would make more likely a much calmer environment. That would allow for a big relief rally. But yeah, look, we haven't had a bear market in quite some time, you know, and we've also had a 4-year bull run, so it's not unusual that we're seeing downside. In fact, the average annual decline, peak to trough, is 14%. So we haven't even hit that, just on, you know, as a matter of course. It's not the end of the world. I don't think that's what's happening. But, you know, I think people have to recognize that this type of volatility is normal. You know, over the course of my career, I've gotten these questions, you know, you think there'll be more volatility in the stock market? And the answer is always yes. I mean, you know, we've always had it. I started in 1984, and there was tons of volatility then. There's tons of volatility now, and it's just a feature of the market. It's not a bug.
Okay, well, we're going to transition to our rapid fire game
right.
of this or that, pin you down for some quick answers,
Okay.
quick questions here. You ready?
Okay.
More likely, correction or bear market?
Bear market.
Buy the dip or wait for lower?
Wait for lower.
Rotation or real de-risking?
Real de-risking.
Small caps, catch-up trade or value trap?
Value trap.
Fed's next move, hike or cut?
Neither.
Stay on hold. Inflation, temporary spike or persistent problem?
Persistent problem.
Which are we closer to, stagflation or recession?
By definition, they're partly the same thing. So, but I'm still in the stagflation camp.
Oil, stabilizing or heading higher?
Heading higher.
Geopolitics, market noise or real economic risk?
Real economic risk.
Iran war, priced in or just getting started?
That's a coin toss. I'm going to say just getting started, because I think that there are some risks that have not yet been realized, particularly if we put troops on the ground.
Dollar, safe haven or problem asset?
Neither.
Better place to hide, gold or treasuries?
Treasuries. Short-term treasuries.
AI build out, sustainable or overextended?
Slightly overextended.
AI, opportunity or bubble?
Both.
AI winner you'd invest in regardless?
Anthropic.
Stay invested or raise cash?
Raise a little cash.
US markets or international?
Still international.
Credit markets, stable or starting to crack?
Starting to crack.
Private credit, opportunity or risk?
Risk.
One word to describe the market right now.
Unstable.
One word to describe how you're feeling about the market this year.
Unstable.
We'll leave it there. Ron Insana, he is CEO of Insana Information Partners. Always a pleasure. Thanks so
Charlie.
much.
Good to see you.